The US market seems to be getting increasingly concentrated, with the Mag-7 stocks dominating the show. What's your take on this trend?
Sure. Good evening to everybody who's joining us on today's webinar, and I'll kick off with answering Sonal's question. And we have some slides which will sort of help navigate this topic. So, Sonal, if you can just bring up, the deck.
Sure.
Right. So, absolutely true that, the Mag-7, which is essentially the bunch of companies which are primarily being seen as the drivers as well as the beneficiaries of the artificial intelligence boom, are the ones which are leading the market higher. If you look at the slide, what you'll see here, this is the UBS's in-house Mag-7 index. And if you look at it over the last 3 years, almost last 3 years, because this is 23, 24, and the first 10 months of the current year, the annualized return of this index is 50%. It's up 222% in absolute terms. During this period, the S&P 500 was up 86%, or an annualized return of 24%. But remember that the Mag-7 now make up almost one third of the S&P 500. So in a sense, the strong performance of the Mag-7 is feeding into the S&P 500 as well. So if we just take a different prism to look at the market performance, and we move away from the S&P 500, which is a market weighted index, to the S&P 500 equal weighted index, in which every stock would have an equal weight. So the Mag-7 would make up a much smaller percentage of that benchmark as compared to the S&P 500 market cap weight, where it makes up almost 35%. So that benchmark has delivered only a 13% return over the last 3 years. So you can see that difference. The performance of 7 stocks delivering 50% per annum is pulling up the benchmark to 24%. The equal weighted is up only 13% per annum during that period. Another way to look at this is visible on the next slide. So you can see here what it has meant in terms of valuation. So the blue line that you see is the S&P 500 trailing PE ratio, and the orange line that you see is the S&P 500 trailing price to sales ratio. Now, it is true, and many people have pointed out, that during this artificial intelligence boom, these are essentially profit-making companies whose valuations have moved higher. And you can see that in the blue line, which is the PE ratio. The PE ratio of the S&P 500 is actually below the peak that the PE ratio hit during the dot-com boom of the 2000s. So in the dot-com boom of the 2000s, the PE was almost close to 30 times. This time it is still south of 25. So in that sense, it is not as costly. However, if you take another measure, which is the price to sales ratio, which looks at the market cap relative to the total sales of the S&P 500, that's the orange line. And as you can see, that orange line is actually making a new high. So it is true that the S&P 500 is not being pulled up by loss-making companies as it was pulled up during the 2000 boom. But at the same time, when you look at it on a sales basis, this is one of the costliest markets ever in US history. So US valuations have certainly reached new highs when looked at on price to sales ratio. Now, a question you could ask is, Vetri, how come it's expensive on price to sales but not on price to earnings? The answer to that lies in the next slide, which is to say that the S&P 500, and once again, the S&P 500 led by the tech companies. So on the left hand side, you have the profit margins of tech companies and semiconductor companies, which are in the blue line, and US semis margin is in fact in the black line. So if you look at that, you will see that both these lines have accelerated very dramatically. So from about 2016, the tech profit margin goes up from almost 20% to 40%, and in semis, the profit margin goes up from about 15% to 25%. So these two sectors are a very big part of the S&P 500, close to almost half of the US stock market in market cap terms. And because their profit margins have surged, as a result, it has pulled the S&P 500 profit margin higher, and therefore it has in effect also pulled up the profits of the S&P 500. So once again, to reiterate, when you look at the US market, it is being dominated by the performance of the Mag-7, which are the companies which are drivers and beneficiaries of the AI boom. These are profit-making companies. Their profit margins have gone through the roof. So the P ratios don't seem as elevated, but the price to sales tells you that the valuations in that segment are quite elevated. So, Sonal, in a nutshell, that's the story of the US Mag 7 and how it is dominating the performance of the US market.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.